Thank you for joining us today. Thank you for joining us today. So, I am Harshita Dave, Chief Operating Officer at Athena eLearn, and I'll be your host for today's session. So, today's topic is about loans, savings, investments, and much more, wherein we will be covering all the facets of your finances. So, to enrich us on the same, we have two panelists here with us today, Naisari Mahesh and Satish Mehta. Let me give you a brief introduction about both our panelists today. So, Naisri, she is the founder of Her Money Talks, which is a one stop financial platform for the women. She is also a former banker who's turned into a writer and an entrepreneur, a catalyst towards women empowerment through financial literacy and inclusion. Coming to Mr. Satish Mehta, he's the MD and CEO at Athena eLearn, and he was the founding MD of Sibyl, India's largest credit bureau, and has worked with HDFC for over 20 years. Also, it gives me immense pleasure to formally announce that Her Money Talks and Athena eLearn have jointly come together to become knowledge partners, which will help you and bring value to you and your finances. So before we start the session, I request all the participants to keep themselves on mute. And also I encourage all of you all to ask as many questions as you all have the opportunity to get answers from industry veterans and put them in chat box. We will address all your questions at the end of this session. So without any further ado, let's move on to this insightful and interesting session. So Naisri, we shall start with you. What is financial planning, especially for youngsters and women, and what does it even mean?
Thank you, Harshita. Good afternoon, everyone. First of all, thank you for having me here. It's a privilege to be invited and share the panel with a veteran and an expert like Mr. Satish Mehta. And I'm pretty excited about the knowledge partnership with which Her Money Talks and Athena eLearn is jointly planning, which I'm very sure that which would enrich the youngsters and whoever looking to add value to their knowledge about personal finance. Now, coming to your question about financial planning, we plan everything in life. So financial planning is one such planning. In simple terms, it is when we take a stock of our income and expenses and plan for our current needs, future goals, and all possible unplanned situations. This is the plain sense of what is financial planning. To talk about it in a different and an interesting sense, it is an art of making your money work for you. It is a skill, a life skill that everyone should know. In one way, it is a science of mastering your money, but it is not a rocket science. In another way, it is the horoscope of your financial future. And it is a roadmap towards financial independence, which every one of us would like to have. It is just like it is a plan, like it is a roadmap which take care of your present and your future. So irrespective of whether you are man or woman or youngster or senior, financial planning means the same for everyone. The only difference according to me is that for women, or at least for many women, it is something that the male members of the family take care of. And for youngsters, it is something that they think they're too early to start with. So we need to change this kind of thinking. Otherwise, financial planning is the same and it implies the same for everyone. So I hope my answer was clear. Yeah.
So when you say that it's equal for everyone, then when should one start the saving process? Like, for be it a youngster or be it a person who is at the early retirement, when should they start saving?
Saving is a process when we start thinking about saving what we earn. Saving is different from investment. So saving, I would say, it is a habit which we need to be inculcated in our kids from their childhood. I mean, as early as when they start earning pocket money, we should teach them the importance of saving what they're getting and planning something out of it. So that kind of planning, saving, budgeting, a little bit of foresight, even if it is just managing a pocket money, that is very important. So at every stage, savings means different. The volume we save is different. So there is no age to start with it. When you start dealing with money in whatever forms, you should learn how to save it also.
Very true. So moving on to next question, how do we plan for life event savings like studies or buying a house or other events like retirement? What are your views on that?
Let me put a disclaimer first. Personal finance is a very personal matter. So there is no one formula that works for everyone.
Mhm.
So like I said, what works for me may not work for my friend, because my situation, like my income, my lifestyle, my expenses, the number of dependents I have, everything is different from the other person. But given this, there are some common practices which we all preach. So the first step is like dividing our goals as short term, medium term, and long term. The short-term goals are the ones which is going to happen in, say, in 1 to 5 years time. The medium term are the ones which is maybe happening in 5 to 15 years time. And the long term are the ones beyond that. So again, short term, medium term, and long term goals depends. It varies from person to person. If it is a youngster who's just out of the college, his or her higher studies abroad or some future planning may be her short term, her or his short term plan. But at the same time, somebody who's in their middle age, their children's education can be a midterm kind of goal. For everyone, I hope, at least most of us, retirement planning is a typical example of a long-term goal.
Right.
It slightly varies from case to case, but again, in all these goals, when we say that we have short-term goals or we have long-term goals, there are needs and wants. Certain things which are indispensable for us, like our kids' education, kids' marriage, our retirement, these are the things which are indispensable. But at the same time, certain goals like, okay, I want to go for a world tour. These kind of things are wants. I mean, it's our choice how we want to spend on that. So as a general practice, what we do is that we park money for long-term goals in equities, allowing the corpus to grow despite the market ups and downs, and not to risk with the short-term corpus by parking it in debt funds like some safe, secure instruments like FD. Say, suppose if I want to, I'm planning to buy a house in next 2 years. I don't want to risk with that principal amount which I am planning to spend on it by investing it in equity, but rather than that, I would prefer to park that amount in FD so that it is relatively safe and I know, okay, my corpus is there. So this is a very general practice which everybody do, but there is no set of rule like that. It all depends on how you plan it. I know people who have invested short-term money for their short-term goals in real estate and they have sold it and made money also. So it's purely a personal matter. And one thing which I would like to add here is that we Indians know our needs and wants, legacy plays a very important role in that. So it is not just saving for ourselves. We take care of, we save for our children and our grandchildren also. So what happens in many families, at least, people who are aging now, the thing is that they forget to take care of their retirement planning, but they are well planned for their kids and their grandchildren. So every individual first, they should think retirement planning as an important long-term goal and plan for it in a way that your money grows out of inflation. So that is just one advice which I would like to tell everyone.
So you have briefly mentioned about equity, debt. So the next question is linked to that. What are various asset classes? And should one have a mix of those, or and what stage should they have the mix of those, or they should keep it separate? What are your views?
Yeah, there are majorly there are two types of asset classes, equity and debt. Under debt, all the safe, so-called safe investment instruments like FDs, RDs, PPF, EPF, bonds, and all this come. Equities means typically the share market, mutual funds, and everything. So a healthy financial portfolio should have a mix of various asset classes, both debt and equity. I think we always have a product mindset. Like instead of thinking in terms of asset allocation, most of us, we think in terms of buying a product. It's like people ask, okay, have you invested in FD? Have you invested in shares? So this is how we think. We need to think beyond that and think in terms of portfolio or think in terms of asset allocation. So I will tell some generic practices which we do generally. Typically, there is the 70-30 rule, which is a very conservative rule, which people take like 70% of your assets are in safe debt instruments and 30% you play with it in parking it in equities. That is one way. The second is that it's a dynamic asset allocation, where you change the allocation in equities and debt based on the situation, trends, volatility, and all. There is one way typically everyone think of when it comes to dynamic allocation is the decreasing allocation in equity as you age. So this is typically called your age minus typically your age is the percentage of investments you have in debt funds. For example, if your age is 25, 25% of allocation can be in debt and 75 can be in equity. At the same time, if you are 40, it can be 40-60. So it's like that. It is, I mean, there's no rule like that. The only funda behind is that when you are young and when you have a long term to go, yeah, I mean, it's when you are young, you can take a lot of risk and you have a long way to go. You have a long way to earn. But as you are aging, your responsibilities are increasing. You become more risk averse, and your responsibilities, your life goals are very near, which means you have to park more money in the safe zone. So that means as you age, you increase your allocation towards debt. And if you are young, you can take a risk and you can play and have a long term to wait and see your money grows. So that's a simple rule which everybody can think. And yes, a healthy asset allocation should have a mix of everything. But when it comes to real estate, I have a different take, which I would like to share. Traditionally, when we get a job, the next thing our parents will be advising us to buy a house. Buying a house is a sentiment as well as an investment and a tax saving instrument for many of us because home loan gives tax saving. So investing in property is something like a 3 birds in one shot for everyone traditionally. But today our career aspirations are changing very fast. Nowadays, you change your job location, you change your city, or even change your country. So real estate is such a huge investment where you heavily invest in property. And suppose if you're taken a property and where you have done a very heavy investments, and if you're moving out of the city, you keep your house locked and you keep your money blocked in that. So that is something you need to think more. If you're planning to invest in real estate, what I would recommend is that you need to think more. What are your career aspirations? Are you planning to continue working in the same city, or you're planning to relocate? Consider all this and don't put your don't play emotions or customs play a role when you plan your investment or your financial goals. Plan more based on your needs. So this is all I have to tell.
That's very true. And that was actually very insightful, especially the ratio wherein a young and how do they manage with the age. So our next question is very interesting as majority of youngsters are leaning towards investing in that. So what do you think about crypto? Is it an asset or a currency? And when we see youngsters are investing, then what is your advice to them?
See, last year we have conducted around 300 workshops for youngsters. In fact, it's very surprising. In every workshop, we get one short question about crypto. But frankly, I am not a crypto expert and I haven't invested in crypto. I don't know much about crypto. But one thing which I would love to share is that I know that many youngsters are investing in crypto, and it sounds very exciting the way they're promising the money grow, and it's very exciting. But my recommendation is that if you don't know about anything very clearly, please don't get into it. I feel that a lot of youngsters are investing, but many of them are not clear about how it works. Who all are the players, which are the trustworthy players, what they should be doing and what they shouldn't be doing. As long as you're not clear about these things, my recommendation is please don't get into it. And secondly, I'm not against crypto, but one very generic factor is that there is an absence of a regulator when it comes to crypto, because there's a lot of things which we ourselves not clear, like what are the regulatory guidelines when it comes to crypto investments. If it is equity investments, of course, SEBI is there as a guardian angel. If it is insurance related, yes, IRDA is there, RBI is there. But when it comes to crypto, there is a lack of clarity. So if you end up with something wrong, I mean, you don't have an entity, a guardian angel to take care of it. So that is one thing. But at the same time, if you are very clear about what you are knowing, what you know, and you know really trustworthy players, there's no harm in keep parking 5 to 10% of your portfolio in crypto. But there are a lot of players in the market today. Knowing what is legitimate, knowing what is right and what is not right is very important. So if you are planning to get into it, I would recommend do a good market study and not listen to your friend and start investing in it.
Okay. So coming to you, Satish, what are your views on Nesri's comment?
Well, before I comment on that, and I want to start with the last point she made about cryptos, I think I should say, first of all, that, I'm delighted that we have become knowledge partners necessary. And I'm sure going forward, we will add value together where 1 + 1 will be more than 2 and hopefully more, especially for youngsters who are looking not only to invest, save, plan, but also to maybe buy a house, take a loan, buy a car, and whatever it might be. Having said that, I think all of you should know two things before I go on. I completely agree with Nesri when she mentioned about cryptos. In fact, I would say it a little stronger. And I would strongly advise the youngsters who are on this workshop, on this seminar, stay away just now for the simple reason that people don't even still know whether it's a currency or an asset. The regulations are fuzzy, to say the least. RBI and the government is talking about doing various things to change that perception, and that could include some restrictions and some banning and all that kind of stuff. The volatility, the security is very high. And the worst part is that the kids, and I'm saying kids because I've got a little more white hair than all of you all, are investing a larger percentage of their share of asset and taking that risk. If you had saved 100 rupees and you invested 5 rupees and that kind of went up or down, you could still survive. But if your asset base is 10 rupees and you go and put 5 rupees into crypto, I don't think you should look at it. I tried to look for a book the other day which says Cryptos for Dummies, in this dummies series. I'm still trying to figure out whether I even qualify to be a dummy on cryptos. So I would personally stay away. Having said that, I can't agree more with what Nesri said in the overall comments that she made. I should also tell you guys that Nesri and I have another connection, that we both at some stage in our lives worked for one of India's most admired companies. Now, I'm going to leave it to the audience to decide or guess what that our company is. But at different points, I didn't know Nesri then because I think she's significantly younger. So she probably joined well after I had moved on. But yes, we did have a common history that goes back to a company that we both worked for. But yeah, no, I think it's absolutely essential that, savings, planning is, I just wish I'd met Nesri 30 years ago when I started planning and saving, but 30 years ago, Nesri would have been in school or something like that.
Right. So since you mentioned about the link between you and Nesri, to answer that, the link is HDFC Limited. And coming to it, the next question is about housing. And who better than Satish, you to answer the question. So why should one buy a house and why should one borrow?
Okay. I think why should one buy a house? I would think there are two reasons to buy a house. One is to use it from Nesri's perspective, is to use it as an asset class, to create an asset which has long-term, which is secure, but it is illiquid also. You can't sell a house tomorrow if you needed the money. So you need to plan your assets in a manner that some of it is liquid or semi-liquid, like, fixed deposits is liquid. Cash in the pillow is the most liquid form, but the most unremunerative form, of course. So yes, one should at some stage in life start looking at a house as an investment also. But I think there is an emotional quotient to this whole thing also, which is something which has nothing to do with financial planning or not. And that is that, there's nothing like owning your own house, living in it. And I believe that Indians don't buy houses. They invest in homes. Your memories, your positives, your negatives, you got married there, your first kid was born there, your parents' savings you put in there. So there is a very huge emotional connect with buying a home. So my advice is, yes, you should look at a house because, again, traditionally, houses have appreciated in value. So short answer, yes, you should look at a house at the appropriate time in your life.
Okay. And adding to that, why should one borrow?
Well, I think, borrowing is a function of financial planning as much as savings is, right? Because if you save and if you have money and you save it correctly and prudently, then obviously you need to borrow to buy a house. Now, you might borrow for two or three reasons. I think there are three broad reasons I can think of. One is that when you borrow, there is a tax saving element, and that's the lowest important, but I'm just putting it up front that you get some benefits for the interest that you pay under Section 24 and under Section 80s on your principal amount. The second reason you borrow is because there is a opportunity cost of money also, which is that if you don't borrow, what you would do is then you would have put your own savings and asset into buying that house that you want to buy. Whereas you might find a better avenue to save or to invest in, say, gold, or I don't want to say it, but crypto or whatever. The main reason today I would say you should borrow is because I, in my entire life, have not seen interest rates so low. Today, you're getting housing loans at anything between 6.4 to 6.6%. And I think that is probably the lowest I have seen in my entire career of interest rates in India. These were rates we used to dream of. We used to hear about the US and other countries charging 5 and 6% on housing loans, and we used to say, wow, when will we ever reach that? Because we were always 9, 10, 11, 12 sometimes also. So I would think definitely if you're buying a house, you should borrow. I know the Indian psyche typically is not to borrow, but I think that is definitely changing and evolving. For example, between you and me, Harshita, you would borrow before I did.
Obviously. Yeah. So, moving on to next question. There's a saying, fools build houses, wise men live in them. And what are your thoughts on this?
I think that saying is historical now. It was the good old days, and it actually started from the UK, where post the World War, there was a lot of rental housing coming in, and people who would rent houses and go and live in them. Now, it actually gave a boost to the economy because people who could build houses build them, and people who could not own their own houses would go and rent these properties. Even today, if you look at a city like Bombay, there's a lot of rental housing, but there are more houses which are remaining locked up because people are not comfortable giving it out on rent because of the laws that don't, that protect the tenant and all that. But I think this thing about that fools build houses and, wise men live in them, a lot of us will be qualified as fools, now. And I think, that philosophy or that adage that existed is now past. So I think you should, at some stage, rightly look at housing both as an investment and as an emotional comfort also.
Yeah, I agree to you on the housing part. Coming to you, Naisari, where we left. So there are various terms, volatility versus safety, risk versus return. So can you help our audience balance these apparently conflicting approaches?
Okay, I will not call them as conflicting approach. Risk and volatility both are common financial jargons. So volatility is more of a mathematical concept, whereas risk is kind of psychological concept. So volatility in a financial jargon, it refers to the swings, the ups and downs of the market, like the indices, the interest rates, which an investor have little or no control at all. Whereas risk on the other side is a personal matter. It refers to your money personality. It refers to your action, which you have full control, and the outcome of it also at your control. It is not in your control. Yeah. So it is impossible to predict the way with which a stock market will move or how much it will move. But it is up to you as an investor to take calculated risk based on your risk appetite. So that's the difference between. So these are not conflicting. Based on the market volatility, the investor have to take a decision, and based on his or her risk appetite, they have to take a risk. Decision like where should they invest, how should they invest, and when should exit.
Yeah, true. So,
Arshita, if I can just add one quick line to what Naisari said to supplement or complement what she said. A lot of people come to me, and advisors, quote unquote, saying, sir, you should invest in this. It's a 5-year lock-in and you will get returns like this. Now, I often tell them my age and that shuts them up. Because honestly, if you tell me today to take a risk on an asset which is going to give me returns in 10 years, I think it's a question of how old you are also. right? The younger today, by God's grace, whatever corpus I've built, I need to protect it and get reasonable returns. And therefore, if I apply Naiseri's formula of, my age, a large chunk of my savings will be not in equity.
Very true.
Yeah. So, Naisri, moving on to our next question. How do one balance between the principles such as tax benefits, returns, safety, and liquidity? And what should be the core guiding principle for the same?
Well, these are four different concepts,
Yeah.
but I think people tend to mix up all this or compromise one for the other. So tax benefit is a savings. So you save the money which you are supposed to pay as tax. So it's a pure saving. Returns is how you make your money work for you, what you're getting out from your investment. Safety is, it's more of a psychological aspect, like how you want to park your money, irrespective of what returns you're getting. And liquidity is like making your money available for you when you need it. So these are four different things, but four different ingredients of a financial planning, which are not conflicting, but should complement to each other. So I'll talk about it through an example. Yes, you need to save tax, but some financial products, like some investment products, come with tax benefits. Like you get tax benefit when you invest in, say, suppose ULIP. ULIP is a typical example of a product which when you invest, you get a tax benefit out of it. But many people invest in certain instruments just for the sake of tax benefit and not thinking about the returns. Like I mentioned, ULIP is a typical example. Like we have seen, like corporate employees, like during the month of March is the time when they start thinking about tax saving. And of course, you will have the good old insurance advisor or your personal banker calling you and selling an insurance for you. Best shortcut, you go buy a ULIP or an insurance policy, save tax. But you're saving tax there, but you're compromising on your returns there. So this is how, when you typically do these kind of things, these kind of principles are conflicting. Similarly, many people I know, even if they can make the down payment, they go for a home loan route to save tax. So it is up to you to decide like how to plan your investment. Don't mix up tax saving and investment together. Similarly, when it comes to returns, like we discussed about the risk personality or the risk appetite of a person. If you are risking too much, like maybe you can earn more, you get better returns. At the same time, if you are just parking, if you are a very risk-averse person and a good amount of your money is invested in traditional investment instruments only, you are safe, but you are compromising, you're not allowing your money to grow. So it's a balance. It's a balance of all these four ingredients, and a thorough knowledge about what needs to be done is more important.
Yeah, very true. So our next question is very relevant to in this market wherein the equities are falling, stock market is falling. So what is your view on gold, and should one purchase an ETF or metal?
We Indians have very sentimental about gold, especially I think women. They are very emotional when it comes to gold investments. Women who have daughters will understand, I think. But according to me, gold is a balancer. It is a passive investment instrument because gold is always inversely correlated with stock market and could help you during an economic slump. Because when the market is up, gold is down. When the market is down, gold will be up. So typically anyone can allocate 10 to 15% of their portfolio towards gold. You can definitely invest in gold if you have an aggressive portfolio. But when particularly addressing your question, whether physical gold or e-gold, I would say e-gold just because the ease of transaction. Because if it is physical gold, first thing you have to buy, which means making charges on all other taxes, things will be there. Secondly, you have to store it. Again, when you need money, you have to liquidate it physically. So all this comes with things that is today's thing. I mean, days are very different, not like the past. It's very difficult for managing all these things. So e-gold is the simplest and easiest way of purchasing gold. Like you buy gold in an electronic form. Buy and sell gold through gold ETFs is just like as you trade in stocks. So I would recommend gold ETF only rather than gold, physical gold. I mean, the sentiments, emotion, where Indian weddings, big fat Indian weddings, keep all those apart. I mean, apart from that, definitely more convenient is gold ETF. And I would like to add e-gold also. There is another product which may be more convenient for women. I mean, who think, okay, ETFs is something I don't understand, is e-gold. It is very simple. Like you can invest in gold starting, say, even 1 rupee. There are platforms which is allowing to invest gold in even 1 rupee. And maybe in return, yeah, you can sell it and buy gold jewelry. So you can try your different new age or new methods of investing rather than physical gold.
Oh, that was very interesting, the e-gold concept. I had little idea about it. So moving on to our next question, equities can be perceived to be very exciting, but the returns are very volatile. So what do you think about this?
First of all, I would like to tell that let's not scare the investors by saying in equities are very volatile. It all depends on how you are investing. See, if you are looking for a short term, somebody is investing in shares for 1 year and withdrawing it after, exiting from it after 1 or 2 years. Yes, yeah, you may end up with loss. But to be frank, equities are essential ingredients in any financial portfolio to beat inflation. Without that, we cannot grow our investment. Yes, there is a risk while investing in equities, but there is equally another risk for not having equity in your portfolio because you are not allowing your money to grow. At the same time, there are ways to reduce risk in equities. First is think in long term. When you park your money in equity, don't think of 1 or 2 years time or something like that, but always think of long term. Like I mentioned before, your long-term financial goals can be money you are parking for your long-term financial goals can be safely parked in equity, allowing time to grow your money. Second is that investing in equity through mutual funds is pretty simple. Anybody can try their hands in it without risking much like stock market investment. Because in mutual funds, you have portfolio managers, you have fund managers who are taking care of, who are watching the market closely and who have the track record of performing and managing your money on your behalf. Then thirdly, there is this so-called new concept for people who want to invest bigger amount. It is called small cases. So a small case is a ready-made portfolio. It's a basket of stocks to invest for people who want to invest in a particular idea, theme, or a sector. So you can try these different routes to enter equity markets than directly investing in stock market. But if you are well read about stock market and if you are an expert, no harm in you can take a risk in investing. I don't call it a risk. You can definitely invest in equities and think for a long term.
Absolutely, I agree to you. So coming to you, Satish, we'll pick from where we left. So what are the tax benefits you get from for borrowing a house? You mentioned briefly about it. Can you elaborate a bit?
So, so there are two broad sections under income tax where you get a benefit. One is under Section 24. And there again, there are two parts to it. Section 24 of the Income Tax Act, where you get an interest write-off on the loans that you have taken. And there are limits. Now, the reason I'm not mentioning the limits is because day after tomorrow, these limits could change because the budget is coming out on the 1st of February and there might be some changes. So if you, and again, it depends on what tax bracket you are and what kind of investment you made. Are you taking a rental house or are you giving your house on rent or are you self-occupying and all that? The second set of deductions are again covered under the Section 80s, 80C, 80, I think DEA or sometimes one other section where you get some write-off on the capital amount. Now that's a unique one because normally worldwide you get write-offs on the interest component. India is probably one of those few countries where you also can club along with your other investments some deduction on the principal amount. Again, the figure is, it's an aggregate between 1,50,000 or something. But again, if you didn't have, say, life insurance policies and you only took a housing loan, you could claim that as a deduction. But these and of course, when you take a loan and your house is not ready, the interest that you pay on the part disbursement, also you get an opportunity to write that off over the next 5 years after you take possession. So there are unique and different tax concessions available. And the best person to advise you will be one who understands your tax returns first, where you are and I think what Naisari said about personally, about planning your investments, asset allocation, risk, appetite, and all is a function of where you are in life. Same argument applies on the loan side also.
Okay. Moving on to next question, should one take a joint or an individual loan? And any specific advice to the women who are listening to us today?
So is that a question, since it's a women-oriented question, for Naisari or for me because it's a loan question?
Both of you all can answer, but we want to listen to you, a male's perspective, and then we'll move to Naisari.
All right. So I think, as you all know, when you buy a house, you normally never buy it in an individual name, right? Because then it's just easier, God forbid something happens, or you want to pass it on to your wife or your spouse or whatever. So the moment you have two names on the property, then the question of whether you should take a loan individually or not becomes irrelevant, because every lending institution will insist that if you are a co-owner of the property, you have to be a co-applicant on the loan. The other advantage is that increasingly, most of the lending institutions give a very small, but they do give a benefit to female borrowers, right? Now, the men can call it gender bias, but I think it's a good thing in our society and culture, especially as you go down to the tier 2, tier 3 cities, to encourage home ownership also for women. And I think that's very important, right? She may be earning, in which case, of course, she will participate in the loan servicing. So I think in a housing loan, it is always good to have joint owners, and that is the answer to the question. And therefore, you will automatically have joint borrowers. Naisari, I don't know if you agree with this, but this is my feeling. Always have, and historically it has been shown. If you look at a country like Bangladesh, and I'm shooting myself in the feet by saying women are financially more responsible than men are. They plan, they save, they do all the right things, whereas the men, meet me afterwards and I'll tell you what I do with my money.
Very true.
In fact, I should also add one more. The government also, in their, Pradhan Mantri Awas Yojana, which is there, and they have this credit links interest subsidy. They've said there should be a woman borrower in one category also, So I think there is a very clear need and an effort to encourage home ownership amongst women. And the short answer to your question, joint ownership, joint loans. Naisari, I don't know if you
completely agree with Satish, and I would like to add one more point. Today, metros, we know the property prices are so high, which means the amount of loan you are taking also more. And given more and more women are on workforce today, they are also earning like men. And when it comes to a joint loan, it increases your loan eligibility. You can take more loan. If you are in need of more money, joint loan application always enhances your loan eligibility, and you can take more amount. Secondly, nowadays, yes, just like Satish has mentioned, it is all about equal rights, equal responsibilities, everything. When I was working with HDFC, and I was with the Loans Credit, in fact, one interesting factor is that many, of course, it was not joint. It was, few years before, and it was not, the joint home loan was not a trend because men tend to take all the financial responsibilities in their shoulder. But surprisingly, many women, like wives or the spouses, are not aware of what is the liability they are having in their families, what is the EMI their husbands are paying. These kind of things they were not aware, because it's just like they don't involve in the things. There are two, cons in this. One is that always the financial responsibility or the financial stress is always on the men. But of course, women can support men in that. Secondly, when something bad happens, like if something like your business crashes or something unforeseen happens in a family, then only the woman is getting prepared to repay a loan, or then only they feel the pain or the burden of a financial liability you're having. So it's always good to have joint responsibilities and joint ownership when it comes to properties.
So Ashita, just to kind of make sure that I'm putting my money where my mouth is, when I bought my house, my wife's name was first and mine was second.
That's good to hear.
Oh, that's good.
So coming to you, Satish, again, there are various terms thrown on us by the lenders: teaser rates, fixed versus variable rates, prepayments, etc. All are very confusing. So can you please elaborate on these terms?
Sure. So I'm going back to when I started my career, we didn't have variable rates. So, whatever interest rate was charged was fixed for you for the next 15, 20 years. Now, with the integration of the housing finance industry into the normal economy and the volatility and the decontrolling of interest rates that has happened over the years, interest rates from a balance sheet side perspective for a lending institution have become variable when they borrow from somewhere. So when they borrow from somewhere and the interest rate is changing depending upon market conditions, they have to have a hedge against what loans they're giving, and so that they maintain their profit margin or their NIM or whatever they call it. So I think variable rates is the way forward. Most institutions are almost not doing fixed rates anymore. And if at all they are, the rate is always a little higher because that's their insurance against interest rate going up. So I would say you should always take a variable rate loan. When you talked about, what was the other thing you mentioned, variable versus fixed then?
Prepayments, teaser rates, all.
Teaser rates is something that is out of the window now. At one time, it was, it was very popular. A lot of lenders to get people and tease them into borrowing from them or doing a balance transfer from lender institution A to B would encourage you by giving you a 4.5% or 6% loan when the normal rate was 8%. This is exactly what happened in the US. And that's what led to the prime rate crisis that happened about 10, 15 years ago. Because what would happen is I would appraise Harshita for a loan, assuming an EMI at a lower rate because of the teaser rate. 2 years later, the EMI would go up because the interest rate has now bounced back to the normal rate. And you would default because your servicing capacity was not there. Now, this teaser rate is not something that the lending institution is necessarily bearing also. There's something called subvention. What happens is that sometimes the developer, in an arrangement with the lender, agrees to pay that lower rate of interest. And there have been these instances also. Now, what you have to also be careful about, most importantly, is that if the developer is not able to pay the interest that he's agreed to pay you, your credit score is going to get spoiled. So you have to be careful. And when interest rates jump up, what can easily happen is you could be in a situation where you're not even paying the interest on the loan. Then you go into a different angle, and I'm not going to talk more about it, so don't ask me, but it's called negative amortization.
Yeah.
Whereas the outstanding principal actually starts going upwards before you can pay enough to bring it down. Honestly, I would tell people, take a loan, variable rate, pay it on time, and sleep well.
Yeah, very true. So just to add on that, we have a module, concepts in maths. So you all can apply for that module, and you all will get better idea about all these terms and more terms in the housing finance space. So moving on to our next question, which is very close to Sir. What is credit information report and score? And tell our audience something about this, and what should a common man think about this? And how is it related to housing finance and loan and borrowing?
See, unfortunately, we probably got 5 or 10 minutes left. I can go on and on about this. But credit information is basically information about your credit. So if you've taken loans, credit card, housing loans, personal loans, education loans, all the lending institutions, be it banks, NBFCs, HFCs, and all, under law, are required to give this information on a month-on-month, day-on-day, week-on-week basis to the 4 licensed credit bureaus. There are 4 licensed credit bureaus in this country. The obvious one which everybody thinks of is CIBIL, but there are 3 others called Equifax, Experian, and CRIF Highmark. And all the lenders have to give data. So tomorrow when you apply for a loan, the lending institution that you're applying to will actually access one of these 4 bureaus, and it's their choice, to get your credit history. It's a mirror. It's like your blood report. When you go to get a blood report, it gives all the behavior of your blood in terms of the various parameters. Similarly, this will reflect your payment history. Now, there is this famous phrase that says that past behavior is the best predictor of future behavior. So if you've been paying your loans on time, the likelihood that you will pay on time is higher than somebody who has not been paying on time. So it's a very objective and useful tool which can be used by lenders to take a decision on risk. It does not mean that if you've got a bad payment history, you won't get a loan, but the pricing of that could be different. Increasingly now, lending institutions are actually pricing loans based upon your credit score, which brings me to the second part of your question. What is a credit score, right? Now, we all are familiar with numbers, right? For example, if you say somebody is very tall, right? You say, all right, very, very tall. All right, 7 feet. Now you have a number to put your benchmark to. Similarly, if you ask me, Mr. Ambani is very rich, right? But if you ask the beggar on the street, then Nesari and I are also very rich by that person's standards. But if I say that Nesari's got $10 million, now I have a number of what richness is meant to be. Nesari, I hope you earn that one day, but just as an example. Right? So I think, the score is a reflection, or the quantification is a number. In India, it ranges from 300 at the lowest to 900 at the highest. And it says whether you are likely to pay or not pay a loan. I think every individual now, and I'm very glad that's happening, is conscious of their credit score and the impact it has on not only their ability to borrow, but at what price and on what terms will they be able to borrow. So I think increasingly the importance of credit bureaus. And India, the credit bureau industry is about 20 years. In the US, it's 200 years. So we have a journey to do, but like somebody famous said, a journey of 1,000 miles starts with the first few steps. So I think individually, all of us should be concerned about, especially people like you who are going to borrow. By God's grace, hopefully, I've reached a stage in life where I don't want to borrow anymore, but I still take credit cards.
So adding to the same question, what are the do's and don'ts to keep the score high?
Pay your loans on time. Short answer. I think borrow discreetly. Don't just borrow for the sake of borrowing. Don't take 5 credit cards when you don't need 5 credit cards. People think credit cards are great. According to me, credit cards is the most expensive way to borrow money. If you don't pay on time, they charge you anything from 35 to 40% interest rates, right? So I use credit cards as a convenience. So if you have a credit card, pay it well in time. Use it as a convenience. You go to a restaurant, you go to a mall, you're buying an electronic item, please use your credit card. You don't have to carry cash, but pay it back on time. So, and don't borrow unnecessarily. And of course, the main thing, do not be delinquent, right? Which again goes back that you should borrow, cut your coat according to your cloth. That's simple as I say. Don't borrow for the sake of, credit cards are actually a convenience, right?
So coming to you, Naisari, if you have sufficient funds, then one should invest or repay their loans.
That's a very interesting question.
I'm waiting to hear the answer to that one, Naisari.
So before that, it's so lucrative. I'm just adding to what Satish has mentioned. Today, it is so lucrative to take a loan. So because anywhere, even if it's an e-commerce site, when you try to buy an expensive item, there is an easy option by just click of a button, you can just convert it into EMIs. So for today's youngsters also, it looks like it's very easy, very convenient just to click a button and take a loan and own anything that you want. But given all this, whether to invest or repay a loan, it completely depends on your personal situation. But there are some factors which you can consider. First is like how much investments you already have. Second is what stage your loan is. Third is other liabilities you are having. And fourth is, do you have other enough tax saving instrument? It is not very important, but I'm just adding it as a point. So just elaborating it a little bit. Say, suppose if your investment are not enough to meet your goals, you are not able to invest so much to meet your various financial goals, it is better not to touch that amount and repay a loan, but you can service a loan, because that amount is something if you have parked for your life events. Second is that there's a rule which we all know, that all your liabilities, which means your EMI outgoings, shouldn't exceed 40 to 50% of your monthly income. Which means if you are planning to take a new loan for something else, if you have an existing loan, better close it and then take a, rather than servicing 2 loans and having a heavy liability every month. Third thing is that when comes to a loan, depends on what type of loan if you're having. Say, suppose if you are having a personal loan which is having a higher interest rate and a home loan which is having a lower interest rate, better you can close your personal loan first, because that is an expensive loan for you. And coming to home loan, it depends on the stage of your home loan, because as you all know that during the earlier stage of a loan, the major part of your EMI, maybe 99% of your EMI is going towards the interest and nothing is adding to the principal. So if you are at early stage of your loan, it makes sense to repay your loan. But if you are in later stage of your loan, like if your loan is just 2 years more or 3 years more, that means whatever you are paying, majorly it is going to your principal amount. You are not paying much of interest. You might have already paid it. So in such cases, it makes sense to continue servicing the loan so that you get tax benefits also. So these are various scenarios where you should know and take an informed decisions based on your personal situation.
So if I can add one more thing, Nazri, to this, and of course, what you're saying is like music to my ears, because this is spoken like a true HDFCite, I think, and but more importantly, also you have to look at one more angle. What is the opportunity cost of the money that you have? If interest rates are going down and you're not able to earn enough and you're paying a higher interest rate than what your money is earning you, then it makes sense to repay the loan, because you're paying 8% or 7% on your housing loan and you're getting 4 or 5% on your savings, because you put them into fixed deposits, because that's your asset allocation. So I'm sure Nazri, you agree that, you got to trade off the return that you're getting against the return that you're saving.
Yeah. I'll just tell a simple example out of that. Say 10 lakhs loan, if you're taken for 10 years at 10% interest, you will be repaying 15 lakhs or 15.85 lakhs to that. But if the same 10 lakhs for 10 years, you have put in FD at 6%, the return you will be getting is 18 lakhs out of it. Same way, 10 lakhs for 10 years, if you're putting the amount in mutual fund at 10%, conservative 10% returns, you will be getting 26 lakhs as your returns. So it is up to you to compare and decide whether you should repay or continue.
And if you don't know what to do, I think you all know who to go to.
Yeah. We are always there to help.
So nicely moving on to next question. There's a lot of financial mis-selling. So what are your views on that, and how should one not get trapped in the mis-selling?
Yeah, so like I mentioned, one of the major reasons for financial mis-selling is that we all have this product mindset. Like, have you invested in this share, this market, this product? This is how typically we all think. So playing on this consumer sentiment, it's very easy that companies also try to sell products to you by showcasing or by highlighting the returns. A typical example of a mis-sold product is a ULIP, which is masked as a product which offers, guarantees you a lot of return. But we have to think insurance is not an investment. Insurance means insurance. Investment means something else. You cannot mix up both. When I was working in a bank, I know people who have invested in ULIP thinking that it is mutual fund. They don't know where they have invested it, because company name looks similar. The way it talks about the returns look similar. So people tend, okay, I have invested in mutual fund, and come with the papers. And when we look at the paper only, we are telling them, no, this is not mutual fund. This is insurance. So this has been happening. So one of the major reasons for mis-selling is that the lack of current information. People are not aware. When it comes to money, you have to do a little bit of homework, take informed decision, knowing what is available in the market. I think, money still is a very private conversation in our families. We are not talking about what is the trends. Maybe it looks boring, or maybe it looks something full of jargons or something. It's still not a lifestyle according to us. So we should be having this kind of conversation. Okay, what is the new product come? What are the new things? Then only we come to know it. Okay, what is available in the market? Otherwise, what happens is that a salesperson who talks very well come to you and can easily sell any wrong product to you. And so more important is to have awareness, do a bit of homework, then not to do transactions with untrusted sites or unknown people or schemes which you are not aware or without Googling about it much. And when it comes to money, it is very well that we all, it's a psychology, like we all want to double our money in a very short time frame. But frankly, there is no shortcuts for doubling your money. So whenever we have the shortcuts, of course, the players or various brands also just play with it, and easily, it's very easy to sell different products and services to us.
A classic example of doubling your money is the crypto. I'm sorry, coming back to that. Everybody thinks that, 10 rupees is going to become 20 rupees overnight. It'll become 1 rupee also, possibly. If you're ready for that, then please go ahead and invest in that. But please recognize that there are legislations and regulations coming on crypto. So I think you should wait before you jump into this one.
Another classic example.
Sorry, please go on.
No, I was
That-
just saying another classic example can be MLM. People who have made money out of it are talking much about it, but people who have lost money are not talking about it.
Harshita, you have about 5-10 minutes, so you want to wind down and then say, some questions which we've answered and some which we've not.
Yeah, that's what. So there's a concept, buy now, pay later, Satish. So majority of youngsters are using that concept. So what are your views on that, buy now, pay later?
So buy now, pay later is a reality. I would call it a kind of a surrogate for somebody who can't get a credit card, right? Again, if you know, recently the RBI is saying that they're going to come in with some kind of regulation for this, right? So I think the buy now, pay later, if you look at the P2P, which there was a question I saw, all these are evolving instruments or whatever you want to call them. And I think the buy now, pay later is basically to expand the market of people buying something which they can't afford to pay today. They can't get a credit card. So when I get an EMI on my credit card, it's like buy now, pay later. But somebody is bearing that cost. It is either the retailer like Chroma or Vijay Sales or whoever, or it is a lending institution that is bearing the cost because they want people to use their credit card, expand consumer lending. So buy now, pay later is something that's going to stay, but will have to be classified in some manner so that there is a regulatory environment, because otherwise you're going to have a very unregulated, huge volume of population who is borrowed, who can't pay, and that could set off an economic or social crisis. Right?
Yeah.
So P2P lending was the same thing. It started as a little trickle and now it became a flood, and then the RBI classified them as NBFCs of a special character. Similarly, a buy now, pay later offering, and my worry that many of the fintechs are concentrating on the tech part of it, but they should also worry about the finance part of it and the risk that goes with lending to people. It's not only about technology that, Naisari got a score of 800, so let's give her a loan. But you got to understand many more things about Naisari's financial position and condition before you, especially when you're giving home loans, which are very large ticket sizes and long term.
Yeah, very true. So coming to the end of the questions, Naisari, do you have any closing advice or remarks for our listeners?
I just wanted to add to what Satish just mentioned. There are a lot of fintech platforms, coming for in the space of financial services, where technology becomes more important and not the product. It is so lucrative. So it is up to you to make the right decisions. And the space is becoming so cluttered, and it is when it comes to technology, it looks so cool. So, but it is up to you to take the right decisions and the right platforms when it comes to your finances. Secondly, as representing a women's platform, I would like to tell that today more and more women are in workforce, they are earning, which means they are financially independent. But active involvement and understanding of financial matters needs to be geared up much more to match this kind of newfound financial freedom. So we need to have more open money conversations in families and equal participations. And even with our kids, we should be having this kind of conversations to help them have a healthy financial life, healthy credit score, and not to go by this buy now, pay later kind of trends, which are a lot available today. So that's all I have to add.
Yeah, and I just want to say that together with Naisari and this new knowledge partnership that we've done, we're hoping we'll come out with a more comprehensive approach to your finances so that you look at both sides of your balance sheet, your savings and all that, and your borrowings, because whilst, there is a line that divides assets and liabilities in the balance sheet, the two are intertwined and you can't do one without the other. So I think that's the important thing. And as we go forward, we'll come up with joint products, services, solutions, whatever. And I'm hoping that we'll have a more constructive conversation with Naisari soon, because we've just announced the knowledge partnership. But I think to conclude, be prudent. It's not about a lender who has to be prudent to give you a loan. As an individual, you should also be prudent where you're investing, what are you buying, what is the risk involved, and when you borrow, please make sure you can service the loan. That is the only thing you should do. Can I service this loan comfortably? If you can, please go ahead and borrow.
Very true, very true. So so here we end the question answer round. Now we'll be moving towards the questions of our audience, and we'll answer those questions.
Yeah, so if some of the questions have already been answered,
Yeah,
or if there are comments, then you can ignore them. But if there are questions that are specific, which have not been taken either by Naisari or me, I think we should quickly do it because we've already overshot. So let's give it another 5-10 minutes.
Okay. So we have a question from Champa Ganguly. He says that I have FOMO
She
regarding
says, I know
cryptocurrency.
her, it's she.
Oh, I'm so sorry. So I have a FOMO regarding cryptocurrencies. Is it too late to get into this space?
I think we've answered this one.
We have answered this.
Yeah, so any question, you don't have to feel bad if you don't mention someone's question. If you've answered it, you can ignore it.
So there's a question. Is this a good time to borrow for a home loan, which you have briefly
Yeah,
answered?
we've already answered that.
Yeah. So what is the optimal down payment that a person should put in for the house? And can one finance a down payment along with the actual home loan?
So, the optimal down payment is driven by two things. One, there is a regulatory limit that as RBI has said that you have to put in 10, 20% depending upon the amount of borrowing you're doing. The second, of course, depends upon do you have the money to put it in once you meet that regulatory requirement. And that's a combination of course, having the money and balancing it with your plan to save for a life event, which Naisari talked about. That's the second. Can you finance your down payment? I know there is one company, and I'm not going to mention names here, which actually also finances down payment. But the model very clearly is that the developer subsidizes that. So you get it at interest free, but the developer is subsidizing the interest cost, and this company arranges it for you. But honestly, I think to have skin in the game, you should put in 10, 20% at least, and then borrow as much as you need, of course, and how much you can service.
Yeah. So next question is, what is your opinion about the new age companies where focus is on building image and market share rather than profitability? Should we invest in such companies? Naisari, I think this is for...
We have covered it. My last comment was on that, the populating space of fintech companies.
Don't even read out the question if it's already been answered.
Okay. Yeah, so majority of the questions are being answered. So this session comes to an end. Thank you, Naisari and Satish, for this insightful session. It was very helpful for us and we got to learn a lot of things. Now we can plan our finances in a better way. And if not, we have you to come for look forward to. So thank you so much. Also, anybody who wants to reach out to Naisari and Satish personally, the email IDs are in chat box. You all can reach out to them anytime. Thank you so much, everyone. And also you will get your recorded session of this on your emails. So you all can look it afterwards also.
Or forward it to people you want to.